Hello everyone, my name is George. Welcome to this educational video, one of my first big educational videos, and we're gonna focus on trading the range. So this whole idea, this video got inspired by an article I wrote about 3 years ago, which was also called Trading the Range. But I feel like a lot of the things I explained there changed quite heavily by times today. Obviously, markets change, the way markets trade change. So I felt like an update would be a good idea. In this video, I'm going to explain how I see things on the charts, especially on Bitcoin. So nothing in here you have to take for granted. Obviously, there's people out there who trade ranges in all kinds of ways. And this is just my view, how I see things, and what works for me. All right. So, disclaimer: nothing you are about to read, hear, or see contains financial advice. This video presentation is for entertainment purposes only. Trading is a dangerous game. Trade at your own risk. All right. The topics we're gonna talk about today: ranges in general, identifying range, liquidity, highs and lows, key highs and lows, OTE, the optimal trade entry, supply and demand, breakers, trading setups, then sweep without confirmation, sweep with confirmation, trading the played out range, trading the mid range, confluence, probabilities, and then conclusion. So as you can see, we're not only gonna talk about ranges, we're also gonna talk about some different strategies and things I use in my trading, and then we'll combine those together and talk about the trading setups specifically. So in general, what is a range? Whenever a market is ranging, is moving sideways and is trading between two boundaries, we say that price is trading in a range. We call the upper boundary the range high and the lower boundary the range low, and then the 50% between those two levels is called range mean, range EQ, the equilibrium, or the mid-range, whatever you want to call it. Above our range mean, so when we're trading in the upper half of the range, we generally say that price is bullish, and when we're trading below our range mean or in the lower part of the range, we say that generally price is bearish. When do ranges occur? After an impulse move or a trending market. So we have an impulse move down in this case, and then when price starts going sideways, that's when a range occurs. Or exact same the other way, whenever price impulses up or we have a trending market to the upside and price starts moving sideways, that's what we call ranging. Identifying a range. So we're going to give 4 examples of when to identify range. Obviously, you can have all kinds of situations when you're looking at a chart. For example, right after the impulse move down, when the first low made before a bounce is swept, after the impulse move down, when the first low made before a bounce is not swept, but the first high after a bounce is swept, and the played out range. Probably, this is not very clear to you, but we'll go in depth on every single one of them. So first one, right after the impulse move. So as you can see, down move, impulse move down. The first low after the down move is what we call range low, or we're gonna take as a range low. And the first high after a bounce is what we're gonna take as a range high. Very simple example. So down move, impulse move down, first low made before we see a bounce, we take as a range low, and then where we reject again and start dumping again is what we're gonna take as range high. Exact same for the up move, impulse move up, the first high after the up move, or when we see rejection and we start dumping, we take as a range high, and then where we bounce again and start moving up again after the high, we take as a range low. Example in live markets, impulse move down, first low made after we start bouncing as a range low, and the first swing high made after the bounce we take as a range high. Same way the other way around, impulse move up, first high made after the impulse move, range high, first low after the high where we started rejecting as a range low. Now after the impulse move down or up, when the first low or high made before a bounce rejection is swept, okay, so we have a down move, first low after the down move as a range low, again exact same, then the high after the bounce as a range high, and then the low is swept. So whenever the low is swept, you don't want to take this one as a range low, but you always want to take the low that got swept already as a range low. We're gonna talk about liquidity later, and the way I use ranges the most is based on liquidity and based on stop losses. So it's very important that we take the lows that got swept as a range low, or the highs that got swept as a range high. Okay, so exact same on the other way. So up move or impulse move up, first high after the up move as a range high, low that led to the sweep of range high, or the high that got swept as a range high and the low in between as a range low. Example in live markets, up move, first high after the up move as a range high, the low that led to the sweep of range high as a range low. Okay, so as you can see, this high got swept, so don't take this high as a range high, but always take the high that got swept already. After the impulse move down or up, when the first low or high made before a bounce / rejection is not swept, but first high or low after a bounce rejection is swept. So we have exact same, first low after the down move as a range low, range high, the high after we bounced, after before we got rejected as a range high, and then the high swept previous key swing high, so the previous key swing high is our range high. That's exactly the same as the previous one, so don't take this high as a range high, but always take the high that got swept as a range high. So exact same way, the way around. Impulse move up, first high after the up move as a range high, and then don't take this high, this low as a range low, but always take the low that got swept already as a range low. So this low swept previous key swing low, previous key swing low is range low. Okay, so this one and not this one. Live markets, up move, first high after the move up, and then this low got swept here, so you know this is going to be range low, this is going to be range high. And then the played out range, that's just a name I gave it, since there's no clear name for it. But whenever I talk about a played out range, I talk about a range where the highs and the lows got swept. Once again, we're going to talk about liquidity later on. And yeah, whenever you have a played out range, the liquidity above and below the high and the low got taken, so there's no clean draw on liquidity, and that's why I called it the played out range. Okay, so high got swept, range high, low got swept, range low, sweep of the previous high, sweep of the previous low. So whenever a chart looks like this, where we've taken the highs and taken the lows, we're talking about a played out range. Example with candlesticks. So as you can see, range high swept, range low swept, played out range. Okay. Then something else, when identifying a range, take the most isolated highs and lows. All right. So in in this example, these are the exact same charts, except this is the hourly chart and this is the 4-hour or the daily chart. So it's just zoomed in a little, and as you can see, some people tend to take these kind of highs as range highs and not these ones. Always take the most isolated highs as range highs. And what I mean by that is, as you can see, if you zoom out to a higher time frame, you can see that these highs just disappear in this candle and that these highs are still on the chart. So whenever you go to the, obviously higher time frames will always be king. So always take the most isolated highs, zoom out and check if the highs are still on the chart, and always prefer those highs. And exact same with the lows, obviously. And then yeah, just take the range that fits the best. Look for PA that fits. What I mean by that is just take a look at, take a range high, take a range low, and check how price reacts to the mid-range if if it's a pivotal level, for example, and look for confluence around levels. For example, if you take a range high and you have a weekly open lining up, or your mid-range lines up with the monthly open, a daily open, if your range high is Monday high, if your range low is Monday low, stuff like that, right? Always just use your brain and look for the most logical range you can use. All right, now let's talk about liquidity. So liquidity, a big word in the industry, obviously. A lot of people talk about it in different ways. And I'm gonna try my best to explain it the best I can. So we obviously, retail traders, don't use the sizes the bigger players, whales or institutions play with. And the bigger players need, or the institutions need liquidity to fill their orders, right? So what does that mean? They need to fill their orders in the order book. What they need for that is, so whenever they want to buy into the books, they need people to sell into the books. That's just how markets work. Whenever you buy, somebody else sells. Whenever somebody sells, someone else needs to buy. Okay, so liquidity can also be described as the impact on price. So whenever those institutions or bigger players enter the market, what impact has their trade on price? Whenever the impact is big on the market, you tend to say that the market is illiquid, and whenever the impact on price is smaller, you tend to say that that you have a, whenever the impact is smaller, you tend to say that you have a more liquid market. Okay, so where does that liquidity come from? Well, above key highs and below key lows. Why? Because that's where stop losses are going to be resting. Whenever you have a cluster of stop losses, what does that result in? In buy or sell orders. Okay, and those key highs and key lows and those stop losses are always going to attract price. So for example, people shorting here put their stops above the highs, and people longing, for example, here put their stops below the lows. They think they're safe. Okay, price starts moving. What you very often see then is the bigger players take those stops. They use those stops to fill their orders. Okay, same for here as here. They fill their orders, and then price eventually moves into the other direction. And yeah, so leave all of the retail behind. So take those stop losses, fill their orders, and then move price in the initial direction. Whenever something like this happens, so whenever you take stops and move in the other way, we call that the sweep of a high or a sweep of the low. Okay, so you're gonna see me talking about a lot about sweeps, and this is exactly what I mean by that. Liquidity that gets taken above highs, or liquidity that gets taken below lows. A phenomenon we see a lot then that is purely based on liquidity. So it's just an example and to give you an idea how liquidity works, right? So you dump, make a kilo, you bounce, and then you make a series of lower highs, building up liquidity to the upside. What I mean by that is people who are shorting here put their stops above this high, shorting here above this high, shorting here above this high, shorting here above this high, which means there's a shitload of stop losses resting above all of those highs. And whenever price then continues to dump, takes out a key low, what does that mean? There are stop losses resting below the low as well. So people who were longing into this got their stops resting below this low. Those stop losses get taken, ideally into demand. We'll talk about demand later. What does that mean? The draw on liquidity is massively to the upside because lower stop losses or lower liquidity has been taken, and stop losses or higher liquidity has not. So the draw is massively to the upside. And what you often get then is you accelerate into the low and then just reverse it back and take all of those stops at once and then just sweep off all of the higher liquidity. It's the exact way around. By the way, if you make a series of higher lows and then accelerate and sweep a high, then price very often tends to instantly reverse and take all of the lower stops. All right, OTE is what we call the optimal trade entry, and very simply said, it's the 7.705 Fibonacci level. So we have the 0.62 level and the 0.79 level, and the EQ between the two, or the 50%, is the 705 level. And the area between those levels, and especially the 705 level, is what we call the optimal trade entry. You're gonna very often see that price trends down, for example, or price is just dumping from a high to a low, and then it bounces, and very often you're gonna see that price rejects from that OTE. It retraces in there, and then that often gives you nice entries for trades and to trade the lower high towards new lows. Or exact same whenever you have a low and a high. So from the low to the high, you draw the OTE. Very important, by the way, take the swing low to the swing high, or the swing high to the swing low. That's how you draw the OTE. And then look for longs on the retrace on the higher low into OTE. So the 705 level, or the area between the 6.2 and the 7.9 Fib levels. Live example, as you can see, nice pump. Don't FOMO long into these bullish candles. Always wait for a retrace. And what retrace are you looking for? OTE 7.9 and 6.2 level, in between the 0.705 level. As you can see, draw the OTE from the low to the high and look for longs on the retest. Okay, on the retest of OTE. And as you can see, price bounced nicely from there. So yeah. Another concept I use all the time, to be honest, is supply and demand. Again, people use supply and demand in all kinds of different ways. This is just how I see supply and demand. So yeah, whatever supply and demand you're watching, you always want to look for sideways price action before a bigger move. So for example, sideways price action before a pump, or sideways price action before a dump. Whenever you have sideways price action before a pump, you call the sideways price action demand. Whenever you have sideways price action before a dump, you call the sideways price action supply. Okay. Whenever price returns to those areas, you often get a bounce from that area. Why is that? People whenever you bounce or get a pump from sideways price action, we generally say that people were accumulating longs or were accumulating buys, were bidding the markets, and whenever price returns to that area, they're gonna want to defend their positions, which is why price very often bounce from that area, especially on the higher time frames. Exact same for supply. Whenever price moves sideways, people are accumulating shorts or are selling. Then price moves. Whenever price returns into that area, you very often get rejected and start dumping again. So that once again can give you nice entries for trades. Example in live markets, sideways price action, as you can see here, low time frame sideways price action that led to boom, strong up move. Price dumps again. Where does price bounce here? From this sideways price action. So this area is what we call demand. Exact same the other way around. As you can see here, sideways price action on Bitcoin. Price dumps, strong down move, price returns to that area, and guess what? Exact same from that area, people defend their positions, sell into this, and boom, you get straight continuation down. Breakers. What do we call breakers? Whenever supply or demand break. Very simply said, as in the previous, as in supply and demand, sideways price action, price pumps. You don't bounce from the previously demand area. And as I said, people were accumulating buys in here because price pumped. Whenever price ignores that demand and breaks down below, you very often get that area is gonna act as resistance. And guess why? Because people are wanna get out of their buys from here, which results in selling pressure. Okay. Whoops. Exact the same way around. The other way around. Sideways price action, a dump. People were accumulating sells here. Price ignores the supply to the upside but breaks above. And when price retests that area, people want to get out of their positions as soon as possible, so that results in buying pressure and price bounces to new highs. All right, now maybe the biggest part of the video, which is the trading setups. So, as I already said, my strategy or how I trade is mostly based on liquidity, and the ranges I draw is purely based on liquidity. So how I use ranges with key highs and lows is all about stop losses, taking those stop losses and moving into the other direction. And the easiest way to give you a view of how that works is you have a range high, a range low. Whenever range high gets taken, you want to look for sells, and the draw on liquidity is going to be towards the other side of the range. Okay, so the same way around. You have a range low, you have a range high. Range low got swept. What does that mean? The draw on liquidity is to the upside. Now, obviously, it's not only about blindly selling a sweep of range high or blindly buying a sweep of range low, but we're gonna get into that later. But this is just to give you an idea of how the draw on liquidity works. So as I said earlier, people put their stops above this high. Those stops get taken. Shitload of stops below here. Price gets attracted towards those stop losses and reverse to the other side of the range. Now you can trade this phenomenon in two different ways. You either assume that price is going to sweep the highs or sweep the lows and instantly reverse, which is when you just blindly sell and blindly long into the sweep. Or you can wait for confirmation, which means you break back inside of the range, which shows you even more weakness and then sell into that with your stop above the high, or the other way around. Whenever price sweeps the lows, breaks back inside the range, you see confirmation, you see strength, and then look for longs, stops below the lows, and target range high. Now, why I always target just the other side of the range and not extend my targets is because of this phenomenon where where we talk about liquidity, because of those stop losses. Because what you very often get then is you take the lows, okay, you move to the highs, sweep the highs, and price starts chopping again in the middle of the range. So you just want to get in where price has a clean draw on liquidity, and get out as soon as that liquidity has been taken. Now, as I said, it's not just about looking to blindly buy or blindly sell the sweeps of those range boundaries. There's obviously more to that. Now, these are my kind of setups that I would take anytime, any day. Why? Because of the confluence, okay? So what I mean by confluence is look for as much reasons to get long as possible, or look for as much reasons to get short as possible. In this example, for example, nice sentence, we have our sideways price action, pump, make a low, okay? So impulse move up, range high, range low, as we saw. Range highs unswept, and you sweep range low and guess into what? Into OTE, lining up with that demand. This range low has been taken. Where's the draw on liquidity? To the upside, long the sweep, target range high. Exact the other way around, sideways price action, price impulses down, price dumps. You have your range, the range high got swept, guess into what? OTE, lining up with clean supply, short, put your stops either above OTE or above supply, and target the other side of the range. And then this is the exact same, but as I said in the previous, slides, wait for confirmation. So yeah, that just depends on how confident you are that price is going to reverse from the area you're watching. If the confluence around the level you want to blindly short or long is high, so if you have a monthly open, for example, there as well, a weekly open, it sometimes is better to just enter the trade, because then you can also just put a wider stop, and once you reclaim the level, you either trail stops and add on, or just hold the initial position towards range high and potentially even higher. Because in these kind of situations, as I said, draw is on liquidity is to the other side of the range, so I will always take off a portion at range high. But since we have built up demand and the trend is to the upside, you can keep some and target some higher targets. Exact same way around whenever price is trending lower. All right. Example in the live markets, clean as hell, right? As you can see, price consolidates, moves sideways, demand marked out by the green area, price pumps, we have our range, price sweeps the lows or deviates the lows into OTE, almost to the tick, into that demand, long, stop loss below demand, below OTE, and target the highs. Okay, as you can see beautifully. In this case, you could have also waited for the reclaim, and as you can see, perfect retest of that range low. Keep your stops below the lows and target the highs. Exact same here. In this case, sideways price action that led to the pump got front ran, but that's fine. If you wanted to long into the sweep, but you couldn't because you got front run, wait for the reclaim. The sweep did happen. What does that mean? The draw is to the upside. Look to long, stop loss below the low, and as you can see, your risk reward is still above 2, which is fine. Then trading the played out range. So as we talked about, whenever the high and the low got swept, I usually take a step back and don't try to trade too much. Why? As I said, whenever you have a played out range, there's no clean draw on liquidity anymore. So that means you very often are gonna get pure chop in the middle of the range until you break out and get a significant move again. If you do want to, or you want to look for scalps, try to look for confluence as much as possible, again at the range high and range low, so at the boundaries of the range. An example here: range high, range high got swept, range low got swept, you build a high, start chopping again, the high gets taken into OTE, into range high. What does that mean? Local draw on liquidity is gonna be to the downside, so look for shorts. Clean invalidation is above OTE and above range high. You could even pull your stop slightly higher to above that high, and the target is simply going to be, if you have kilos resting here, take some off along the way down, and then ultimately target range low. Okay, as you can see, in this case, again, draw OTE from the high to the low, so swing high to swing low. OTE, look for sells on the retest. Always look for a high being swept, so the liquidity, the draw on liquidity is resting lower. Okay, live example here of this concept. As you can see, by the way, it's not always just about a sweep, a quick wick above and back below, but it's very often also about just spending some time below range low or spending some time above range high. That's one of the biggest things that changed since a couple years ago, like 4 or 5 years ago. Back in those days, you could literally wait for the candle close, and whenever you got the candle close back inside the range, you just shorted and price instantly moved into your direction. Sadly, that does not sometimes it works, but not very often. What you would tend to get more now is like a deviation, how we call it, or spend time below and then reclaim the level and break back inside the range. So it doesn't matter if it's a quick wick above or if it's spending more time below, because ultimately, if you're gonna zoom out, all of this price action is gonna result into a wick anyways. So yeah, it's just about the idea of taking stop losses above the highs or taking stop losses below the lows, and seeing where the next draw on liquidity is. As you can see in this case, we had from our high, so we had our range, so impulse move up, range high, boom, dumped, range low. Range high got swept, range low got swept, we bounced, we draw our OTE from the high to the low. Where do we want to look for sells around OTE? As you can see, a high was swept. You either wait for that, wait for the rejection, and then short it with your stop above OTE, target the lows, or you just blindly short OTE, stop loss, clean invalidation above range high, and target range low. As you can see, in both cases, your risk to reward is above 2R which for me personally is fine. Trading the mid-range. So you could ask yourself, yeah, we're talking about these range boundaries, and but what is the mid-range used for? The mid-range, personally, I use for continuation plays to the upside or continuation plays to the downside. Whenever you have a trending market up, price then starts rejecting and starts moving into the other way. So you're trending down again, make a low, make a high, sweep the high, and then break back below the mid-range, which is in bearish territory. Then that makes your draw on liquidity to the downside. The trend is trending down. The trend is down, which makes it higher probability to look for shorts. So once we break below the mid-range, we're in bearish territory. There's fresh liquidity resting to the downside, while upside liquidity has been taken. Look for shorts with stops above range high. So as I said, downtrending market, the highs have been taken, and you're because if you take the high, you could still argue that this is a higher high, right? And then you want to wait for the break back below your range mean, and that's when it's confirmed that you're more than likely going to go at least for range low and potentially even lower. So what you want to target then is, as always, take some off at range low, and after that look at previous price action, look for key lows, and always take some off at those levels along the way. As you can see, I always when I talk about entries and exits, it's always about it's always about key highs and key lows, right? And that's purely because of the concept of liquidity, and because price gets attracted towards those places where stop losses are resting. Also on the lower time frames, by the way, you very often get like those 15-minute sweeps where you just take those kilos and then instantly move into the other direction just to trap people out of their positions and fill bigger orders. An example here, price rallies, you make a range high, make a range low. The low has been swept. You have equal highs above. That means even more stop losses resting to the upside. Once price breaks back above our range mean, that's your signal to long. Invalidation below range low. Why below range low? Range low has been swept, so liquidity has been taken. Would price dump below range low again, that would be ultra bearish, so that would invalidate the trade. So enter on the reclaim of your mid-range targets, take some off at the highs, and then these levels, obviously you can't see them right now, but those are key highs as well. As you can see, high liquidity target those highs and take some off along the way. Probability. So as I already said, what increases the probability of a trade succeeding? What is the probability, the likelihood of a trade succeeding? Look at what the trend is, right? If you're, obviously, I said ranges occur after a trend or after an impulse move. But nonetheless, if the trend has been bearish, right, and you start ranging, shorts are always gonna have a higher probability to succeed than longs. Same way around, if you're in a bullish trend and you start ranging, longs are always gonna be higher probability than shorts. Then liquidity, as I already said a couple times, you always wanna look for key highs, key lows. Look for areas where those stop losses are gonna be resting, and those are the areas where you're gonna wanna look for trades, right? Look for the draw on liquidity. If the lows have been taken, look for longs towards key highs. If the highs have been taken, look for shorts towards key lows. And then maybe the most obvious one, support and resistance. Look at the most logical levels, right? Use your brain. If you see a key area where price has interacted a lot, look for sweeps of those highs into those levels, or look for sweeps of those lows into those levels, and that's where the probability of your trades succeeding is gonna be the highest. Conclusion: that's gonna be it for today. I hope you enjoyed. I hope you learned something. Once again, this is just my view, how I see things, the concepts I use. Everyone uses things the way they're used to it, the way that works for them. This is what works for me, what has been working for a couple of years. So yeah, do with it whatever you want. If you enjoyed, leave a like on the video, leave a comment, sub to my YouTube channel. If you want to show me some love, use one of the links I'll leave in the description. One of my exchange links that helps me a lot. Join my free Discord. It's completely free. So yeah, if you want to support me for doing all of this for free, simply use one of the links. And then thanks for the inspiration. These are the guys I learned from. These are the guys that inspired me to do this kind of video, to give you a view. And I know those guys from back in 2017 or maybe earlier. So big shout out to them. Give them a follow. These are their Twitter ads. All right. So I hope you enjoyed. If you did, leave a like. And yeah, maybe I'll do a next one in the future. We'll see. Peace out.